Well, as we heard, that threatened downgrade for the United States meant a real downgrade for equity markets. I spoke to Lonsec's Geoff Beeston for the details. Well, Geoff Beeston, thanks for your time.
Thank you, Phil.
Well, not a pretty day, Geoff. Do we blame the US?
Well, I think the US market was due for a correction after a very strong rally in the second half of March. We saw some selling in the US markets overnight, and we saw the risk trade continue to be unwound in the local and Asian markets today. The worst performers on the local market were the energy and materials sector, down around 2% respectively, while the defensive safe havens seemed to outperform, only being off 0.5%, being the healthcare and the property sector. Overall, the ASX 200 range traded for most of the afternoon on above average volume and was off around 68 points.
And you'd think all of this would have been good for the Australian dollar, people getting back out of the greenback and US Treasuries, but we're off almost a cent on this time yesterday. How so?
Well, that's right. I totally agree that a potential outlook downgrade by S&P on US debt should have resulted in a higher yield curve and a weaker greenback. We actually saw the opposite occur, and this is because I think that the US public debt position is fairly widely understood in credit markets. In fact, we saw the opposite occur, i.e. we had a stronger greenback, which resulted in a weaker Aussie dollar overnight. This was also coupled with the RBA minutes, which came out mid-morning, which showed a weaker than expected gross domestic product for this quarter and rates to be on hold for the medium term. We saw the Aussie dollar fall about 50 basis points off this news.
Well, plenty of red on the markets, as we've stated, but any winners?
That's right. There wasn't much good news on the market today, but one announcement that actually caught my eye this morning was the completion of the Origin Energy renounceable entitlement issue, which actually raised $2.3 billion. Now, the thing that caught the eye was the 79% take-up rate from investors, which is well above average. And this really shows the market's confidence in not only management, but Origin's corporate strategy. I think there's going to be some good news in the pipeline with a potential $80 billion deal with Sinopec, which is one of China's largest petrochemical companies. Origin's definitely a company to watch.
Okay, Geoff, we'll have to leave it there. Thanks for joining us.
Thanks for having me, Phil.